All right, everybody. Thanks for tuning in to a little market preview here. I'm glad you did because there are definitely signs of, well, that make me concerned. Well, I don't know if concern is the right word, but make me think that the market is about to head lower. I don't think we're looking at a crash, but I think we could be looking at a pretty decent sized move. And I will explain why. Uh, One of the first things to look at, which is not in the stock market directly, but it has an influence on it, is this Institute for Supply Management put the PMI report out. They put it out the first of every month, and it's a pretty great report. It's free, and you get a lot of good insight out here because they're not really selling anything. They're just, in this case, just reporting facts. So they interview people in these various industries and just seeing a couple kind of bearish things. Our economy appears to be slowing dramatically, says someone in the copper and electronics products place, starting to feel softened in the economy, so forth and so on. All right, so let's go look at the market. And the first thing I want to look at is how overbought the S&P 500 is and how it is at resistance. Now, there tends to be resistance at former resistance levels because you have people who bought back here who now they can finally get out of break even and they're like, "Ugh, I can get out of break even. I'm going to sell." So you got remorseful buyers from back here selling here. And if there's enough sell orders, it creates resistance at the level that was resistance. The market was also overbought. This will draw sellers in because they're going to be expecting a reversion to the mean. Overbought just means that it's trading at a level that is above or beyond what would be its typical or normal trading range. So things revert to the mean, whether it's in the stock market or anything else in life. So overbought is going to draw in some sellers, overstretched at a former resistance level. This sets the stage up where it's going to be easier to go down than to go up. So I'm going to be looking for a move lower. The next thing I want to point out here is this rapid change in sentiment. All of a sudden, bullish sentiment has gone to an extreme. This particular institution here asked their members, are you bullish, bearish, or neutral? And the amount of members who say bullish has gone to an extreme. The amount who have said bearish has gone to an even bigger extreme. What does this mean? Well, if the vast majority of investors are bullish, what do? They invest their funds. And the market runs out of buyers, and that's it. The only way it can go is lower. Now, check out over the past year. Unfortunately, they don't show the lowest, but trust me, this is the lowest in a couple of years. But they do show the most bullish high was in July, and the most bearish high was last December. So if we go and look at that, all right, so where it was the most bearish was time to buy. If people are really bearish, what have they done? They sell. Market runs out of sellers, only place can go up. People are really bullish, what do? They buy. Market runs out of buyers, the only way it can go is lower. Now, a big catalyst for this is to watch interest rates. All right, so this is the 10-year yield, and we are going to talk about this as though it is a stock because it's just easier to visualize. This is actually interest rates. And we're looking at is the inverse of the bond. So I don't want to get too confusing, but because it really kind of doesn't make a difference. I'm going to put in the Bollinger Band here as one of my favorite indicators. Now, the Bollinger Band is 2 standard deviations below the 20-day moving average. And why is that important? Well, it's a different way of measuring overbought or oversold. And now we've gone below it. So this is going to draw buyers into this market, which really means sellers into the bond market. But let's just work with me. It's going to draw buyers into here and push yields higher. And that could be a catalyst for the market moving lower. So let's just take a quick look through these sectors here. I'll just kind of show you what I mean. Tech is kind of just going sideways. So, man, really, believe it or not too much going on in the tech sector, but you got to really keep an eye on Apple here. Apple is 7% of the market, and it's been testing this really clear support at 190. All right. Now, some of these other big stocks are looking really weak already. Microsoft broke its uptrend. There's weakness in Google, so forth. But Apple has been trading sideways, and if this support breaks, that could be yet another catalyst for the market to move lower. And then if we get away from the market, of course, we got all the news going on over in the Middle East where war could break out imminently, so forth and so on. But keep an eye on this Apple. If there's one thing to really watch this week, it's this. And if this report starts to give, there's a good chance a lot of these markets really start to come in. Because if we look at the different sectors, the S&P is 11 different sectors, and different things run the market at different times. The healthcare sector looks like it could have broken resistance. So there may be a little bit upside here, right? And this is a support level. It became resistance. It's because people buy here and they decide they made a mistake when the price goes lower. When it gets back up to their level, they're like, oh, if I can get it out of break even, I'm going to. So remorseful buyers placing sell orders causes there to be resistance at the level. If we get above it, it's not just a symbolic thing to say it's a breakout. It means that if we've gotten above a level that was resistance, it shows us that the traders who created the resistance with their sell orders are out of the way. So you got supply taken out of the market that could set the stage for a move higher. So as long as the market kind of hangs in there, I think healthcare might slowly trend higher. But if Apple starts to give and bond and yields come up, I think this kind of goes lower too. We can look at our financial sector here. This is also very overbought. This is the RFK and RFK is the RSI indicator down here at the bottom. And when we get above, the blue line gets above this red line, it kind of says we're overbought. So this is kind of stretched out. We can look at our consumer discretionary sector. It looks like it's a little overbought, a little bit stretched out. Pretty clear resistance around 175. There's resistance at former peaks because of that buyer's remorse. People bought and market went lower and they just been waiting for it to get back up to their price so they can get out of break even. So you remorseful buyers placing sell orders at the level that was resistance makes it remain resistance. Our industrial sector, look at this, really stretched out, really overbought. Industrials usually don't act like this. So those are some sectors that are stretched out, and that's the most of the market in terms of percentages. Well, not most, but financials are 15%, consumer discretionaries are about 10%. So that's like a quarter of the market that's kind of overbought and stretched out. We got Apple hanging on there. We got, again, potential Middle East problems. We got interest rates that look like they're about to spring higher. So I'm not saying do anything yet, but just be ready for a kind of a decent move lower. So here's communication services, and this is already broken. This is the sector that Google and Facebook live in, and these guys don't look good. Whoops, sorry about that. There's our Facebook chart. See, this is breaking. There, a lot of times you get support at former resistance levels because you get remorseful sellers trying to buy their shares back. But here looks like we broke that support. So that looks pretty weak. All right, everybody. So you kind of get what I'm saying over here. Just see things that I'm kind of thinking are going to make the market go lower. Sentiment, interest rates, the psychology of being overbought, so forth and so on. Let's just go through the last of these here. The energy sector trading up against resistance. Now, this sector kind of can, even though it's a small sector, it can be kind of opposite of the market because sometimes if this is going up, the broader markets could be going lower because energy prices are getting higher. But I believe this is only about 6 or 7% of the market. But we can see a level that was support became resistance. We got our utility sector, which is a pretty interesting play here. If interest rates don't go higher and start to go down, this sector could start to move higher. So we look like we're on the verge of a potential breakout in the utility sector here, but it's going to be determined by what goes on in the bond market. And last but not least, our real estate sector. And wow, look how overbought this is. All right, folks. So you gotta get it. A lot of things to some important dynamics shaping up this week. And they all seem to be kind of bearish, but the market's always right. We just got to watch it and see how it plays out. And I will talk to you soon. Thank you so much.